Welcome to Global Money Talk, brought to you by Sampro TV. Greetings to all of our viewers from across the U.S., Korea, and around the world. We're coming to you live from the floor of the New York Stock Exchange in New York City, the financial capital of America. I'm Remy Blaire, and joining me today live at the New York Stock Exchange is Tai Wong, independent proprietary trader. Tai, happy Monday and good morning to you.
Well, good to be here. It's an interesting day today for sure.
Indeed. So it is Columbus Day here, Indigenous Peoples Day, but outside of the New York Stock Exchange, there are protests going on, so it's been quite a morning so far.
Yeah, it was a little more difficult to get in here than usually. You can actually hear the chanting from here, and it appears that they're shouting "Stop arming Israel," and I'm thinking that this might be a reaction to what happened over the weekend, where the U.S. is deploying an anti-missile system called THAAD, which let me get it correct. I think it's the Terminal High Altitude Area Defense Anti-Missile System. And you need trained people to operate it. So I think there are at least 100 American troops getting deployed along with that system. So this may be a protest that, in reaction to that. They didn't announce it ahead of time, so apparently it's been quite active morning outside.
Indeed, Tai. And initially, you would think if there are protests taking place, it might be against Columbus Day here in New York.
Yeah.
There are celebrations happening throughout the city, including the parade uptown and around here on Wall Street, over on Broadway, heading towards Battery Park. There is the annual Columbus Day Festival, but indeed it was actually a protest taking place, and it is still unfolding outside of the exchange as we speak. But right now, let's take a look at the markets, because the Dow and S&P 500 closed at new record highs last week, and this morning it does appear as though the major averages are extending gains. So the Dow was lower earlier on the session, but we are seeing it eke out a gain above the flat line with an advance of 0.1%, and we're seeing the Nasdaq advance significantly this morning. It's off its session highs, but it's still up by over 100 points, or 0.6%, and the S&P 500, it continues to soar higher by 0.5% in New York morning trade, extending that record high we saw last week. So, Tai, here we are at the beginning of the week. We have a lot to cover, as you mentioned, geopolitical tensions, but earnings season is underway, and some key names that we're watching.
Yeah, a couple things to think about. Well, today is not a stock market holiday, but it is a bond market holiday. So it was easier for me to park at the station today, for which I'm pretty glad. But we have a lot of earnings, starting with a lot of financials tomorrow. In terms of data, not so much. There's weekly claims, initial jobless claims will be interesting after the big surge we had last week. I think it'll be volatile. That figure will be volatile for some weeks yet. We also have retail sales. The European Central Bank is now highly expected to cut 25 basis points on Thursday, and this was a big change over the past month, because some of the data came in actually quite poor. So, but at this stage, I think there's a dichotomy between what companies have guided for earnings and what analysts are thinking. So there's a view that perhaps these earnings will, because companies have been cutting costs and doing different things, that the earnings may actually surprise to the upside, and maybe why the stock markets are up so strongly today. I mean, the S&P at 5,850 actually. I mean, sure, we could see it at 6,000. We could see it at 6,000 ahead of the election. Part of it may be that looks like that Donald Trump might be pulling out a little bit to a lead, leading in 6 of the 7 swing states in the latest polls, and he's viewed to be generally more stock market friendly. It's unclear on the bond side, but it's more stock market friendly, because if there's one thing for sure, there'll probably be less regulation with Trump. So maybe why the mood seems to be good in the stocks this morning.
And as Tai mentioned, earnings season is underway, and we'll be keeping an eye on those financial institutions reporting this week, as well as other companies reporting. And as we head into the rest of this year, we have a lot of event risk, right?
Yes.
We have the elections coming up, 21 days. It's so hard to believe.
Wow, 3 weeks, right?
Yeah, 3 weeks. It is Monday, Columbus Day, so yeah, exactly 3 weeks from now. we have November 5th coming up, but we all know that the jobs report will be coming out on November 1st, and then we have Election Day followed by the Fed Reserve meeting, and that means the next rate decision. So we'll be keeping our eyes on all the economic data coming out this week, especially when it comes to the consumer. I'm sure we'll be reporting on the retail sales figure coming out this week.
It seems like looking at the futures, the market is still now 86, 87% looking for a 25 basis point cut. And that seems to be the safest route for the Fed. They're continuing taking down their rates, which most people view as well above neutral. But also and they really care about the labor market at this stage, but the two hurricanes that have hit, as well as maybe a little bit of the back end of the port strike, because for the few days that they were striking, maybe some people did actually apply for weekly claims. It's going to be muddy, and I think when it's muddy, it looks highly unlikely they'll want to do 50. They'll probably not want to stop unless something comes out. So 25 basis points, safe, quiet. Most people are happy, not a lot of yelling and screaming. I think that's what the Fed is probably going to want.
And you bring up an important point, because when we think about the upcoming jobs report, the one that's coming out for the month of October, there's so many factors to consider, right? The port strikes, and in addition the two hurricanes, Hurricane Helene and Milton, and those regions are still pulling themselves out, recovering, and some regions are still closed, and over the weekend I heard about sinkholes in parts of Florida. So a lot of devastation, and that will indeed affect the economic data coming out.
And the employment reports due November 1st, but this week is the survey week. So actually, sorry, I apologize. Last week was the survey week. We'll get the results from the survey week on Thursday for weekly claims. So that may give us an idea, a guide to what November 1st is going to be. So this is probably the number of the week, or the single biggest thing that the market is looking for.
And as you mentioned, weekly jobless claims that come out every week on Thursday morning, that is something that we've been paying close attention to. Usually most of the focus was on the monthly jobs report, but the claims figure has become very important because it gives us an indication of what's happening across the country
sort of more
on a
real
weekly,
time.
weekly basis. And Tai, you mentioned that we'll be keeping an eye on the ECB rate decision coming out on Thursday, so I do want to continue our trek around the globe and go to Asia, in particular China, because heading into the weekend we were talking about the announcement coming out from the Finance Ministry of China, and I was reading this note earlier today, and one of the analysts had said that it was actually all sizzle and no steak, which I thought was a funny characterization. But what did you make of what came out this weekend?
So, Saturday morning, I'm looking at this because they had it their Saturday morning by their Saturday evening. Our morning, there were some good write-ups on it. So I would say, in general, it was a little bit of a disappointment. The market was looking for 2 trillion yuan, or 283 billion US at current exchange rates, in stimulus. Maybe half of that going to the local provinces, which are in a lot of budgetary trouble, and the other half trying to really boost consumer boost consumer spending ahead of the end of the year. They really didn't get that. He just gave promises that we will do what's necessary. There'll be announcements coming in due time, and the market, certainly the analysts were like, wow, that's really exactly as you said, sort of, all sizzle and no steak. Not actually that much sizzle to begin with. So the markets last night, Monday morning, opened in China down, but then they actually closed sort of a little bit higher. And before I go a little further on that, the data over the weekend from China was actually quite disappointing. Their inflation was low, month on month 0 versus 0.4 expected. On a year-on-year basis, they only got 0.4% versus 0.6 expected. That's pretty low for inflation going up barely 0.5% in 1 year. When we're talking about a little bit like sort of Japanese deflationary problems that they had over for practically a generation before they more recently seem to have gotten out of it. And then I think exports were weren't particularly good, and imports were low as well. So the data is bad. So why are the stocks up? If you look at where the Chinese benchmark is basically just over. It is retraced almost 50% of the entire rally. But I think the thinking there is the surprises are all likely to be probably good, that they do announce something and you soar higher. If they don't announce anything, we'll just wait for maybe the next announcement and it might grind lower. So if you're the retail investor, you're a speculator, you're thinking, I don't want to miss out on potentially a very, very big rally. I missed some of it because we were on the Golden Week holiday and we rather be long than short. So I think there's going to be a fair amount of volatility in China, as they try to really figure this out. So what was interesting is I was over the late last week. I was doing some thinking about what really is ailing China, and I think we have a little time today to talk about it. If we go to so graphic 1, and I'll ask for your forgiveness ahead of time, maybe a little bit of hubris here, but I tried to look at China and say, what are their major problems, and really get it down to 3 things. The first one is what I call malaise, which is why their economic growth is slowing so dramatically. There's just no spirit in the economy. Why do we have this malaise? Government has crushed growth industries like finance, consumer technology, gaming, and tutoring. One result of that is the youth unemployment is 19%, which is extraordinarily high and very, very bad for the outlook. The government instead wants to focus on state-owned enterprises and exports. And finally, they're sort of infrastructured out. They've built so much infrastructure over the past 20 years. There's how many more bridges and roads can you actually build? So that's one big part. The second big part is the population in China has peaked and will start to shrink, and that will accelerate. So shrink rapidly. So a lower population, more old people who are retiring, fewer people who are taking their place, is going to impact GDP growth over the long term. You can stimulate, you can do a lot of things, but if population drops, it's going to be hard to grow the economy. And finally, the world simply just doesn't trust China. You can see over the weekend in Taiwan, around Taiwan, they did more military exercises provocatively because the president of Taiwan gave a speech on October 10th talking about sort of Taiwanese sovereignty. A lot of espionage regarding China that they've been accused of, and economically they're being accused of dumping cheap exports into other markets. So that's in essence the China problem. So how do we solve this? So let's go to graphic 2, which is the China solution. Now, for most democracies, most countries, those are 3 really, really big problems that are very difficult to solve. But China does have the advantage in a case like this of being a state that can, really has a command economy if they want to. They can be authoritarian. So how do we fix the malaise? The first thing is release the brakes on your engines of growth. So not to say, all right, everybody just go wild and crazy, because you really can't change like that and it would look bad for the government, but ease the restrictions on finance, on technology, on these different areas to let the animal spirits come forth again. You've seen that in stock market, but you need that in the real economy ultimately. So I think that's how you start to fix the malaise. Now, most controversial, or second most difficult thing is your population is peaked. And those demographic changes, once they start, are very, very hard to fix. How do you do that? Well, there are, by most estimates, about 90 million empty apartments in China. The government can borrow money, issue bonds. Their bonds are yielding 2%. If you borrow a lot of money, maybe your bonds will yield 4%. But buy a lot of those empty apartments and offer subsidized housing to married couples who have 2 or more children, especially in those 3rd to 5th tier cities that are having a lot of trouble growing. There's a lot of budgetary issues with the provinces. So if you call that, let's say call that 40 million apartments, an average of 1.5 million yuan each, you're talking about 60 trillion yuan, which is $8.5 billion. Trillion dollars. A tremendous amount of money. but your annual GDP is 18 trillion US. So it's affordable. It's a huge undertaking. And maybe if you start it, you get the ball moving at least not in the wrong direction, and you can at least have the population stabilize, and we'll see what happens. And finally, and this actually may be, it actually doesn't cost very much, but maybe the hardest thing to do. How do you rebuild the trust that you've lost over the last 10 years? China grew tremendously because they were friendly. They allowed the sort of capitalism to run the economy while they ran the politics. Well, the first thing to win back your trust is to say to Taiwan, we will never take Taiwan by force. We don't want the blood of our brothers on our hands. When they want to return, we will welcome them with open arms. Now, will people really trust them to say that? Maybe, maybe not, but it's a start. And it takes away from a little bit of a distraction. Maybe sometimes you do want that distraction for various reasons. But if you can rebuild trust with the world that you lost in part due to sort of different crackdowns, as well as what happened with COVID coming out of China, probably an accident, but nevertheless, you're taking steps in the right direction. It can be done. It's not easy, but I think that really is the solution long term to China. It'll be interesting what they do with it.
And Tai, I'm glad you had graphics for both the China problem as well as the solution, because it really highlights a lot of the major issues here when it comes to the economy, diplomacy, as well as internal growth. And that section you highlighted there in terms of the solution for growth, especially that unemployment rate for the up-and-coming generation, that is considerable. So when you're talking about releasing the brakes for the engine of economic growth, what do you think would actually work here? Because we've talked about the problems and how stimulus might have the engine revving, but in order for the economy to recover and for the sentiment of the people to actually recover, it takes more than just stimulus.
So I think you signal to the financial community, been sort of demonized because President Xi has moved the economy away from sort of conspicuous consumption, which is why I'm actually quite bearish on luxury goods globally as long as this continues, because China is a gigantic market. Nobody's really going to step in there in such a way as they've been. So, LVMH, I'm a little worried about luxuries like that. But I digress. You'd say to the finance community, you want us to be a leader. They said, they're pushing brokerages to merge so they can have sort of leading banks, world-leading banks, in the next decade. Well, actually, the best way to do that is to let the finance community grow. Let sort of the economic capitalism that was absolutely brilliant from 2000 to 2012. That's former President Jiang Zemin and his proteges. China grew unbelievably. Now, you're not going to have 10-12% growth again. The economy is too mature. Like I said, you've infrastructured out. So you're going to have to build the consumer side. You have to build the services side. Goods are still going to be important, but let the people know that, tutoring was a big business. Ease the restrictions. You don't have to remove them like you removed COVID. And remember, they had the most strict COVID restrictions back, I want to say, the end of 2022, and there was a lot of restlessness in the population, and they were saying, well, we may be building up so much pressure here, and one day they went poof, it was gone. So, many deaths after that, but it was forgotten, and they released the pressure valve. I'm not saying, tell everybody, forget what we said, go nuts, but ease everything back. People can read the tea leaves, don't conspicuously consume, but you want to stoke the fires of the engines of your growth.
And it's interesting you mentioned how luxury brands have been feeling the pinch when it comes to the consumers in China, because the big brands, as you mentioned, LVMH, they've been feeling the Chinese consumer pulling back on their spending there, and that is considerable. But when we think about the population of China, give us an understanding of just how massive the middle class is.
So, just to talk about their demographics a little bit, they went with the Malthusian one-child policy. We actually can't feed everybody. Thomas Malthus was proven wrong, but for some reason they looked at the problem in front of them and said, we need a lower population, right? But they didn't really think ahead. Once we start this happening, and granted, it wasn't as clear 40, 50 years ago when they started it, but once you get that demographic ball rolling, people don't want to have kids, especially if the outlook is bad and the engines for growth is terrible, and people spend tons of money tutoring their kids and getting college degrees, and they can't find a job. People are like, why do I want to have a kid? Housing is really expensive. And all of a sudden they changed that policy probably about 10 years or so back, a little less than that. But nobody wants kids now. So tax breaks or incentives, probably not enough unless you improve the mood. But if you offer people, you know what, we're going to give you good housing. May not be in Shanghai or in Peking. We're going to give you in these different cities, Shenyang, different places like that. You're going to get good jobs because we're restarting the economy, and you're going to get cheap rental housing or cheap, housing that you can buy over time, but only if you have 2 or 3 kids. Will that move the economy back, the population back up again? Maybe, maybe not, but you can certainly stop the acceleration of the collapse, which I think you really need to do. And it's really important for a country. If a country is shrinking, it's really hard to grow the economy.
Yeah, indeed. Before we head into the break, I do want to very quickly take a look at the market and, of course, take a look at Boeing as well, because it is leading the Dow Industrials lower. So all the major equity averages do remain above the flat line, with the Dow, Nasdaq, S&P 500 higher, but we are seeing Boeing lower by about 1.2%, so it's come off its session lows, but Boeing did announce that it plans to cut 10% of its workforce, and there are concerns about a potential downgrade for the company. So what do you make of the latest developments with Boeing?
It's a big cut. They're talking about 10% of the workforce, 17,000 people. And it looks like the new CEO is really, Kelly Ortberg has dug his heels in and saying, I'm not going to knuckle under to what he views as unreasonable demands. And Boeing is a stock that's doesn't look good. Lower highs, lower lows, but my view is Boeing has a put. I don't know if where the put is, what exactly put is. Is it a treasury put? But there's only 2 major aircraft makers left in the world: Airbus and Boeing. And I cannot see how the U.S. will allow Boeing to go bankrupt or get into real trouble. I think somebody steps in here. I mean, I don't know if it's a Taft-Hartley type thing, because Taft-Hartley is really, if it affects the country in a big way, might be something where the administration, whichever administration it is, comes in and sits on things and says, listen, you guys, let's fix this problem. So I'm actually looking to. I have a small long position in Boeing. I'm looking to add on on if there's a substantial downturn, if there's a downgrade or something like that, there might be an opportunity to add a little bit lower. I do wonder though if Kelly Ortberg will survive this, because if the board wanted him, the board needed somebody to clean house, but if the strike continues and there's no movement, you can't fire the company. So sort of like in baseball, you end up firing the manager. So will you fire the CEO? It's not out of the question. And then he'll probably get a really nice package for showing up for maybe 6 months to a year, and get a package out of it. But it's something that bears watching, because neither side is moving here, and they're losing money every day. In terms of that income now won't come until much later in time. Next year, they're moving their 777X, I think, back a year now, when they're going to start delivering those wide, that big long-term jetliner. So it's a big concern, and I want to see how this works out.
And with each passing day, as you mentioned, the company continues to lose money, right? So we'll keep an eye on the situation, and of course, if there are any updates from either side of this negotiation table for Boeing, we will bring you the latest. So we'll continue to monitor Boeing as well as what's happening around the globe. So Tai, as always, thank you so much for joining me at the beginning of a very eventful week here.
Yes, great to be here.
Thank you, Tai. And coming up next, I will be joined by Simeon Hyman, Global Investment Strategist at ProShares. Don't go away, we'll be right back. Welcome back to Global Money Talk, brought to you by Sampro TV. Federal Reserve officials were divided at the September meeting over how much to cut interest rates. The majority supported a half percentage point reduction, while a minority supported a smaller quarter-point cut. Now, minutes from the Fed meeting revealed the discussions behind the decision to make the first rate cut since 2020 here in the U.S. with a bolder half-point move. September has historically been the worst month for stocks, but ended the month with positive gains thanks to the Fed. Joining me today at the New York Stock Exchange for our market insight is Simeon Hyman, Global Investment Strategist at ProShares. Simeon, thank you so much for joining me today.
Thanks for having me.
Well, first and foremost, here we are at the beginning of the fourth quarter of 2024. Heading into this year, there are so many expectations for rate cuts, and we finally got that 50 basis point cut in September. But given the year-to-date gains for the equity market, we've seen double-digit percentage gains, and even today we're seeing the S&P 500 hit new record highs. So what do you make of what we saw not just in September, but the first half and the first 3 quarters of the year for the equity market?
Well, it does start with interest rates, but it's not only about the Fed. Let's think about the yield curve for a moment. If inflation gets to 2%, and it looks pretty good, I would suggest that interest rates would look as the following. Inflation 2%, Fed funds rate at 3%, and a 10-year Treasury yield of 4%. Which one has already happened?
Yep.
The 10-year Treasury is already 4%. And more or less, most stocks, particularly large cap stocks, those valuations are driven by longer term interest rates. So that suggests that there isn't a lot of tailwind from Fed cuts for large cap stocks, but neither would large cap stocks likely freak out if, say, we only get 25 bips next time.
And Simeon, you're joining me here on Columbus Day here in the U.S., so that means the bond markets are closed, but the stock market is open. And you mentioned that key level there, that 4% that we've been watching. So what do you make of what we've seen so far year to date when it comes to the bond market?
So it's going to be likely range bound on that long end because the soft landing does look like it's in hand. Yeah. 10, 12 days ago, we had a slightly high CPI, and then PPI looked fine. The labor market looks strong in the U.S. So the soft landing looks pretty good. And if longer-term inflation expectations stay around 2%, 2 plus 2 is 4. I always say that 10-year is driven by kindergarten math. So that guy is likely to be range-bound. Sure, could it go from 3.5 to 4.5? But unless there's an accident, we're likely to be range-bound. But importantly, what this also means is that bonds can for the first time in a generation, do their diversifying job. And what do I mean by that? In the era of quantitative easing, bond yields were pushed so low on the longer end of the curve that they couldn't fall any further if there was a recession or geopolitical unrest, but now they're normalized. And this past summer, when the equity markets corrected 10%, the aggregate bond index went up 6%. This is really important, the fact that bonds, if something goes wrong, nothing goes wrong range bound. But if we have a hard landing that surprises us, or we all pray for peace around the world, but if there's geopolitical unrest and the equity market's really correct, you're going to make 10 or 15% on your longer term bonds. And that's first time in a generation.
And for viewers out there who may not have been paying close attention to the U.S. economy, you brought up a lot of key points there when it comes to the U.S. economy in terms of economic data. So here we are, the beginning, or the middle actually, of October. We've gotten the latest inflation figures in the form of CPI as well as PPI, and we got a huge number for the jobs report in September. So headline non-farm payrolls coming in way above expectations, surpassing 250K, and we got the unemployment rate edging lower to 4.1%. So there are expectations that given some of the weather events here in the U.S., we could see so-called muddy figures for the non-farm payrolls report coming up for this month. But for viewers out there who don't have an idea of what the indicators are for whether we get a soft landing, hard landing, something in between, can you set the stage for us?
Yeah, what you articulated is exactly what we're experiencing in the U.S., which is notably better than anywhere else in the world. This is, the U.S. has the strongest economy right now, and things do look good. You might get a seasonal, something seasonal from the two hurricanes that hit, but by and large, the consumer's holding up, unemployment's there, and more or less inflation looks like it's under control. So I think the other place that we have to look, and we just started earnings season in the U.S., because this does come down at the end of the day to earnings, because if the 10-year is stable, PE multiples are stable, therefore more price appreciation from stocks has to come from earnings growth. So far, so good. Look, we started out of the gate with some strong results from the financials, and that shouldn't be a surprise to anybody, because you're having at least a less inverted yield curve / upward sloping. I think we're officially upward sloping now that we got 4.1 on the 10-year. And look, that's good for net interest margins. And I think for the most part, earnings season should hold up pretty well. Remember, this was a Mag 7 driven thing for much of the year, but we've seen other areas of the market start to pick up and broaden out this rally. We've seen the equal weight index doing quite well, and parochially for us, we're big fans of dividend growth strategies. We've got our dividend growth flagship ticker NOBL, the S&P 500 Dividend Aristocrat ETF. Underperformed for a couple of years behind the tech stocks. Now it's really coming around. So I think the broadening of the equity markets, which should be supported by broadening of earnings growth, is an important story that should support equity prices.
And Simeon, as you mentioned, we have kicked off earnings season. We saw better than expected results from the financials last week, and we'll be hearing from other big financial institutions this week, and we'll be keeping an eye on what we've seen thus far. But as we head into the rest of this year, we'll see how interest rates affect the bottom line for these institutions. Before we dive deeper into this, I do want to set the stage in terms of bonds. So when we see bonds, lower yields go higher. So can you explain what key levels are watched when it comes to U.S. Treasuries?
Sure. Back to that 10-year, it's 4%. When the 10-year rallied and we got notably before 4% a month ago, that should say, hey, participants are really worried about economic strength. And if it rallies way past if it sells off past 4%, if we saw like a 4.5% yield on the 10-year, to me that's the barometer of the market's take on the risk of either inflation coming back or a recession. So I would suggest looking a little bit less at whether the Fed does 25 or 50, but look at the 10-year. 4.1% is great, but if you see 3.5, the market's getting nervous about economic strength. If you see 4.5, it's starting to get worried about inflation again.
And Simeon, you highlighted where we are in terms of the equity market. So the Dow, NASDAQ, S&P 500, the Russell 2000 are seeing gains year to date, some double-digit percentages. So that speaks to the extent of which the market has rallied so far this year. We'll be taking a close look at small caps, but before we get to that, given market valuations right now for the Dow, S&P 500, NASDAQ, given what we've seen in many sectors this year, when it comes to investors seeking income from their equity, what are the different approaches that you're looking at?
The Fed gave at least a modest gift to the equity markets. I know I said it's primarily about the long end, but we'll talk a little bit about small caps. But hey, 50 bips still helps the economy, it helps earnings. So even if it doesn't move PEs, it's still a little bit of a boost to the equity markets. But it is, of course, a salary cut for fixed income folks. So if you needed income before, you need more now. And folks do look to the equity markets for income. And the problem is that a lot of those approaches sacrifice total return. Covered call strategies, this is where you, in effect, sell away the upside to your equity holdings. You sell a call option. Those have been a very popular way over the last few years for folks to get income from their equities. The problem is traditional strategies sell those calls on a monthly basis, and you only get about 1/3 to half the return of equities. Enter the daily option revolution, which you've probably talked to many people about. There are now daily options. Well, you can actually execute a covered call strategy on a daily basis, which we do in our ETF ticker ISPY, iSpy. It's the S&P 500 High Income ETF. When you execute a covered call strategy every day, you can get high income but still participate in equity markets. And that's the key, because in the current environment, you got to have your stocks behave like stocks. Remember, you want them in case something goes wrong, diversification purposes, but your equities, they got to really behave like equities, because the odds are it's going to be a decent equity environment. So the daily option revolution can give you that equity income, but for the first time, get you the full participation in the equity market.
And for the layperson who may not be familiar with how these call options work, can you walk us through a scenario here?
Yeah, it's not that complicated, but if you're not familiar with it, what you're doing is you're selling the right for someone to buy your stocks from you.
Okay.
But it's called covered because you own the thing you're selling that away from. And what that does is it just sells away the upside to the equities that you hold. You could think of it as the S&P 500. That's what we do in ISPY. And if you sell that right to buy something away from you once a month, the equity market could run away from you the first couple of days a month. You have no participation. But if you write those calls every day, write and sell mean the same thing. If you do it every day, as we do in iSpy, you're up at bat every morning. And that allows you to get the income from selling the option. You're paid for it, but still participate in the equity markets more fully.
And would you be able to walk us through the trade-offs that come with this?
Well, the dailies fix the trade-off. In the monthly strategy, there's a SIBO has a index for monthly covered call writing, which is a traditional way to do that. And over the last decade, a monthly covered call strategy has only returned about 1/3 the return of the equity markets. That's the bad trade-off.
Okay.
But it's fixed with the dailies. With the dailies, you fully participate in the equity market. But yes, if you're looking at more traditional approaches, you need to be aware that you're really not participating fully in equities.
And as we head into year-end, we're keeping an eye on a lot of moving parts. We've highlighted them already, whether we're talking about interest rates, what it means for stocks and bonds, as well as geopolitical, macro. We have a presidential election coming up, so there's a lot on the table before we get through the fourth quarter. But what does all of this mean for equities?
So people often ask the question, does the equity market perform better in the U.S. under Democratic or Republican administrations? And the answer is the equity markets have generally done best when government is split. This is not a comment that has anything to do with anything else anybody might be concerned about. This is an apolitical view. But the equity, if you're looking at the stock market has performed best when Washington is split and not a lot happens. The rules were set. Companies know how to behave under them. If there's no dramatic changes to the rules of the road, regulations and taxes, then companies continue to be reasonably efficient and they perform. So again, if narrowly you're only asking me the question about the stock market, it's a split government that actually tends to be best for the equity market.
And here in the U.S., can you tell us how this works when you're talking about split government? What exactly do you mean?
Yeah, we've got the House and the Senate, and then we've got the executive branch with the president. So if the House and the Senate were split, that's one of the best environments for equity markets.
And less than 30 days, actually 21
Indeed.
days
Not
until
too far
November
away.
5th.
Not
So
too far
the
away.
countdown is definitely on, and yeah.
Yes.
Yes.
No, absolutely,
Okay.
absolutely.
Well, Simeon, I do want to move on and talk about high-yielding equity strategies. So equities, as you mentioned, can be a key source of both income as well as growth. But as investors have several approaches to generate income from equity holdings, typically they fall into high-yielding equity and derivative strategies. So first and foremost, tell us about these high-yielding equity strategies.
So I think we'll put a yellow flag on them.
Okay.
We'll park the covered call strategy to the side and just talk about a middle-of-the-road approach to perhaps just buying stocks that have high dividend yields.
Okay.
Now, The challenge with that is the S&P has a yield of about 2%. Dividends are about 2%. So folks will look for stocks that might have a 4 or 5 or 6% dividend yield. Now, if you just think about valuation, PE, turn it upside down, is E over P. Why did I say that? Because by definition, for something to have a high yield, it must be very cheap. And it is absolutely true that in the last, call it, couple of quarters, high dividend yielding stocks have begun to outperform. But those high dividend yielders have two challenges. Number one, they can be low quality. They might be cheap for a reason. And number two, they're hypersensitive to that path of the Fed. What we suggest a little more prudently is not going and stretching for those highest yielders, but I had already mentioned briefly the dividend growers. That's our ETF ticker NOBL. That's the S&P 500 dividend aristocrats, and they're companies that have increased their dividends for 25 straight years. They're also outperforming, but because those dividends are growing, they're number one, they're higher quality, and number two, they're not as sensitive to the precise path of the Fed. It's really an income later plan. The dividends compound, they grow 10 or 12% a year. Compare that to a fixed coupon on a bond, and you have a nice yield, a growing yield, growth of equities, and defense against any inflation.
And I'm very curious about the makeup of that ETF for the dividends. What are some of the top holdings right now?
You got blue chips in there, you got Coca-Cola, Procter & Gamble. It's really a blue chip strategy back from the old days, because I like to think of it as an elegant approach. The only way you can grow your dividend for 25 straight years is if you're high quality, because you can't fake a dividend. It's handing cash out to people. So it really does screen out anything that doesn't have the ability to generate real cash flow and do it in a broad range of economic environments. And that's really the key to the story.
And before we move away from this, I know that it might be obvious to you what high quality means, but when you're thinking about high quality names, what are some of the characteristics here?
When folks think of quality, and I'll go back to my comment that this is an elegant approach, elements of quality could be strong balance sheet, could be strong cash flow generation, could be stability of earnings. And one way to try to find quality stocks would be to take those metrics and put them in a big matrix and do all sorts of high-end math and try to combine them. But if you just look for companies that have grown their dividends for many, many years, all that stuff has to come along. So I call it an elegant strategy as opposed to a simple strategy, because it's easy to explain. It's just companies that grow their dividends, but all this good stuff lies right behind it.
Well, thank you so much for that explanation, Simeon. I think it's very helpful for our viewers who might be wondering, what exactly does that mean?
Absolutely.
And of course, when it comes to high-yielding equity as well as derivative strategies, you highlighted what you mean with the high-yielding equity side. But can you expand on what you mean with derivative strategies here?
Well, on the derivative side, it goes back to this challenge that most derivative-oriented equity approaches sacrifice too much upside. Whether they're those monthly covered call strategies or buffer strategies have become quite popular. Look, we're all scarred from 2022. And what do I mean by that? Stocks and bonds went down at the same time. But we're not in that world anymore. With bonds bonds now have the ability to go up if stocks really take a hit. That means the use case for a derivative equity strategy that maybe protects a little bit on the downside, those monthly strategies, 1/3 the return of the equity market, a monthly covered call strategy, the downside capture, meaning the amount of the decline in the equity market in a down market that those strategies delivered was 90%. You're giving up all the upside and you're barely getting any protection. You need bonds, and you need your stocks to be stocks and your bonds to be bonds, which is why we suggest strategies like a daily covered call strategy to get you the extra income that folks need. Look, you retire at 65, you need income, you might live to 100. And therefore you can't have 100% bonds because you won't make it there. So you have to have an income and growth approach with your equities. Be careful of those derivative strategies that sacrifice too much of the growth of equities. consider opportunities like I Spy where you can really participate in the equity market and deploy those derivative strategies without giving up all the return of equities.
Yeah, before we move away from this, you mentioned 2022, right, where both stocks and bonds were lower, but we always know the longer that you're in the market and have witnessed different monetary policy as well as economic cycles, they say never, right? So can you walk us back to that period, and do you think we might ever see that again? What happened there?
It was quantitative easing. And it began in the great financial crisis, and then it was resumed in the pandemic.
Yes.
So if we walk back to the great financial crisis, Ben Bernanke was the chairman of the Fed. And prior to the great financial crisis, those of us who studied the fixed income markets, we said the Fed only controls the overnight lending rate. And market forces determine the 10-year Treasury yield. And Ben Bernanke had written a PhD dissertation and said, hey, we can artificially suppress longer-term interest rates by buying those bonds and further stimulate the economy. And thank God he did it, because we didn't have a Great Depression, we only had a Great Recession, and it was resumed in the pandemic. But what that did was it left rates so low on longer-term bonds that they could not do their diversification job any longer. Now that quantitative easing is over, quantitative tightening has come in, yields are normalized, they can do their job. If you're asking me whether we'll ever have quantitative easing again, we all hope not, because that would mean something really, really bad is going down. So I think the odds are against it, but it's a tool in the toolbox that thank God we had, and we all know it's there, so it could be deployed.
And with people living longer, that means we might have many, many more decades in the future. So that is something to consider when we're talking about finding that right balance with stocks and bonds.
There's no question that the tool is absolutely in the toolbox. And if there was a really deep recession or a pandemic or a global unrest that's worse than we see today, you could see bond buying of longer-term bonds by the Treasury that would suppress longer-term yields. But by the way, if you own them now, then you would make money off that. Again, on the way down, that would be a money-making opportunity in the fixed income market.
And this segues nicely into our next topic about diversifying risk, because we think about all the risks that are out there, and hopefully we don't experience another pandemic in our lifetime, Simeon, but you never know, we don't have a crystal ball. So tell us a little bit about risk and what you're keeping your eyes on.
The mix of stocks and bonds is the first stop. Because bonds work now, the 60-40 portfolio will truly mitigate risk in a way, again, that it hasn't done in 20 years. But also within the equity markets, there are opportunities to make sure you're diversified. Mid and small cap stocks have begun to perform again after having been left behind by the Magnificent Seven. They're trading at 50 cents on the dollar to large cap stocks. You need to have exposure to smaller capitalization stocks to make sure that not only do you have both stocks and bonds in your portfolio, but that your stocks are appropriately diversified.
And here in the U.S., it's common to refer to that 60-40 ratio of stocks versus bonds. And of course, depending on how soon you get into the market, how many years you have until retirement, then the risk ratio might fluctuate. But can you give us an understanding of how well this works and a little bit more about that ratio here in the U.S.?
Yeah, well, it actually didn't do you any good in the last 15 years. Because of quantitative easing, it really didn't do a lot for you. But again, if you go back to this past summer, it worked. We had that brief 10% correction in equities, and bonds went up 6 or 7%. So we do expect that the 60-40 portfolio to notably mitigate risk. And the nice part about it is it mitigates risk exactly when you need it. Look, if the market's relatively quiet, we're not talking about when yields on the 10-year go up 25 basis points and then the equity market goes down 1 or 2. That's not what we're talking about. What we're talking about is, bam, something bad happens in the Middle East or in Europe, or there's a very hard landing in the U.S. and stocks go down 10 to 20%. that's when you can expect that 4% 10-year to come down to 2.5 or 3, and you make 10% on your bonds. So we're back to the 60-40 having real efficacy, which admittedly it just hasn't had in over 15 years.
And I'm glad you brought up the market volatility we saw in midsummer, the beginning of August 5th, when markets sold off. And there are a confluence of factors there, but we have recovered from that, and obviously we've maintained the double-digit percentage gains for the major equity averages. And here we are, we continue to see some new record highs for the equity averages. But I do want to ask you about duration in fixed income. So when it comes to diversifying risk, give us an understanding of how this affects what we see in fixed income.
It's a really important point. Duration refers to the how long-term your bonds are. So the Fed rate is overnight, your money market fund is very short-term, and then the 10-year bond is a longer duration instrument. Of course, the longest duration would be a zero coupon bond that just keeps paying coupons but never pays back its principal. And bonds can have two roles in your portfolio. One is to mitigate risk and have short-term cash flow needs. That's what you need money markets for. But those short-term guys have no sensitivity to interest rates, so they don't offer diversification benefits. So as we've been talking about diversification benefits, it was a very important question you asked, because that only comes through owning longer duration bonds. Many, many years ago, I used to talk to ultra-high net worth investors on the wealth management side. They had more money than they needed. They didn't have to worry about how to pay the bill the next morning. We told them the only bonds they should own are zero coupon bonds, the most sensitive bonds. The longer your duration, the more sensitive you are to interest rates. So we told them to only own the longest duration things, because all they needed was diversification benefits. At the beginning of the pandemic, a zero coupon bond went up 30% in March. You know what it did in April? It fell 30%. So those really long duration guys are not there to mitigate volatility, but they're there for diversification. The short duration stuff like your money market is there for risk mitigation and near-term cash needs.
And Simeon, we have covered a lot of ground today, and we've been able to talk about a lot of topics here, but I do want to get the opportunity to ask you about small caps. So here in the US, we have an index that we pay attention to, the Russell 2000. Year to date, it's up over 10%, but including small caps in your asset allocation can provide many benefits here. So what do you make of small cap performance that we've seen so far this year, and where do you think the opportunities are? Because you've highlighted some of the risks earlier.
We're fans of small caps as a general statement. They are, as I mentioned, at about roughly half the price of large cap stocks. The performance this year hasn't really dented that performance gap, that valuation gap, I should say. The challenge is that small cap stocks off the shelf, and I mean by the Russell 2000, if you just bought the Russell 2000, you have two challenges. One, they're the most interest rate sensitive. If you really want to bet on the speed of the Fed, the Russell 2 is your friend. But if the Fed doesn't go as fast as you want, they're challenged. Number two, quality is very low. 2/3 of the Russell 2000 doesn't make any money. We think an opportunity to take advantage of the valuation opportunity, but not be quite as sensitive to interest rates and dial up the quality. It's back to dividend growth. In addition to NOBL, our S&P 500 Dividend Aristocrat ETF, we have ticker SMDV, and that's our Russell 2000 dividend growers. And it just takes about 100 or so small caps that have grown their dividends for over a decade, and it really resolves the quality aspect and makes you a little less Fed dependent, but you're still talking 50 cents on the dollar in terms of valuation.
Well, that's interesting you mentioned that. So there is volatility when we talk about small caps. So are there additional challenges when it comes to small caps that investors should be aware of?
We always got to watch for the sector tilts, because if you're picking stocks, if you have an index-based strategy as we do that looks at different ways to take from the 2000, because it's a big universe, you want to take a look at the sector composition that you get. In SMDV, one of the things, if you're doing due diligence, you'll find that there's a little bit of an extra helping of small cap financials. which we think in this environment is really a feature, not a bug, because back to the yield curve's not inverted anymore, some of these smaller and regional banks ought to actually be able to thrive. So for folks looking for opportunities to cull through the 2,000, if you're coming to look at our ETF, do your due diligence, you'll see some extra financials. Other strategies, may have various tilts within the small cap universe.
And Simeon, last but not least, before I let you go, here in the U.S., when we're talking about small caps, what is the actual market cap in terms of size that we're talking about?
Oh, now you're asking me a question off the top of my head. but I believe, hold on, because I'll get this right. If you're doing a traditional asset allocation, you would have, of a 100-cent pie, you would have about 10 or 15% small caps. So therefore, the reason that's the right size pie is because small caps are about 10 or 15% of the U.S. market cap. So that's about the size to think of.
Okay, Simeon, well, we've been able to cover so much ground here today, so I appreciate your time and I appreciate all of your insights. Thank you so much for joining me here
Thanks
today.
for having me. Appreciate it.
My pleasure. And that will do it for Global Money Talk live from the New York Stock Exchange. We're so excited to bring you daily coverage here on Sampro TV. You can check out our content and our show anytime on our YouTube channel by searching Global Money Talk. Thank you so much for joining us, and we'll be back bright and early tomorrow morning. Have a wonderful day.